Good morning, everyone. This is Prateek Monot from Aptivaa. I would like to welcome everyone who's joined us today for our webinar on modular approach to ERM to optimize COVID-19 response. We are very happy to partner with Risk Association of Managers in Nigeria, RIMAN, and we are also joined by the president of Mr. Magnus, who I will just be introducing. I would also like to take this opportunity to give you an overview of what we are trying to discuss today and who we are as a company. This will also help you to sort of understand the agenda and the theme of our presentations today. So the key areas today that we would be, sort of discussing with our on, to how to develop a modular ERM framework to ensure risk coverage, especially in the time of emergent risks, how to prioritize risk issues to optimize COVID-19 response, how to enhance risk management capabilities when we are, dealing with the black swan of an event like COVID-19. And we are also going to have a presentation by Ms. Olaiya, who would actually try to sort of bring in more localized and as a practitioner approach to the table, while we provide a more global banking scenario and how banks have been sort of dealing with those issues. So to start off with, before we start our webinar today, I would like to introduce the president of RIMAN, who's joined us today. His name is Mr. Magnus Noka. He's the current president of RIMAN and also chief risk officer of Coronation Merchant Bank. Mr. Magnus Noka has over 20 years of experience in the banking sector that cut across banks and core areas of treasury, branch management and operations, enterprise risk management, and he holds a first degree in economics and an MBA in Masters of Risk Management. He is also an alumnus of prestigious Lagos Business School Senior Management Program, and he will also sort of giving us a welcome note and giving us the go ahead for starting the webinar. So I would invite Mr. Magnus to give us a welcome speech.
Good morning, everybody. I hope I'm heard loud and clear.
Yes, sir, you are.
It is my pleasure to welcome all our participants from across the globe to this unique webinar. First, I need to appreciate this partnership with Aptivaa, one of the foremost risk management firms that have also shown presence in different geographies across the globe. Of course, I also want to welcome all of us on behalf of Risk Management Association of Nigeria, the foremost risk management institution in Nigeria. I'm particularly excited about this very particular webinar, looking at the theme. And the key word there for me is the modular approach to ERM in response to the COVID-19. And why I say this is an exciting theme for me is for us as risk managers and those who are interested in risk management, I'm not too sure there's anybody who has modeled or who did model the pandemic we saw in this year 2020. Nobody saw it. Nobody had an idea we're going to see it. But that is what it is today. And we have lived with it for the past 9 months across the globe. This is a challenging time for risk managers because the pandemic has also introduced a lot of challenges. And for us as risk professionals, how we approach it is more important than what has happened. The response is more important because in every crisis, there's always opportunity. In every crisis, there's always a solution. So the theme of this webinar today, I would say, is very, very pointed to the issues at hand. And when you think of modular approach to an issue, you are thinking of an approach that is scalable. You are thinking of an approach that is adaptable. You're also thinking of an approach that gives you the flexibility while remaining innovative. So for us today, it is no longer just doing ERM. You must adopt an approach that will help you become responsive to all the issues that we are facing today in the new normal. So as we listen today to our panelists, it is my expectation that at the end of the day, we are going to benefit and see how we are going to adopt a modular approach to consistently improve on our risk management response and of course improve efficiency, because today it is no longer, this is the traditional approach. It is a question of we need to be innovative and we need to be responsive to the emerging risk we see in the new normal. Once again, it is my pleasure to welcome all of us. And as we sit back to listen to our panelists, I'm sure we'll be all enriched by this. Thank you once again, and you're all welcome.
Thank you so much, Mr. Noka, for the kind words and also to set the motion right for the webinar. Before I transfer the presentation to our first panelist, Mr. Ashley, I would like to give a brief introduction to our director, Mr. Ashley Cherian. He heads our credit risk, ERM, and IFRS 9 practice at Aptivaa. He's a seasoned consultant across credit risk, market risk, and specifically, done a lot of projects on ERM and also on IFRS 9. So he's going to bring in, sort of an approach that we have been working with our partners across the globe, in Middle East, in Americas, in parts of Africa. And he's going to, sort of also bring in the importance of having a modular approach. I would also like to request everyone, if there's any questions that you would like to ask our panelists, Mr. Ashley and Mrs. Olaiya, please feel free to write into the Q&A section of your webinar window. We'll try to address most of them in the last part of our webinar. Over to you, Ashley. I'm just giving you the presentation rights.
Thank you so much. Thank you so much, Pratik. So I hope my screen's visible, Pratik, if you can confirm.
Yes, you can see.
All right. Thanks everyone for coming on this webinar and giving us the opportunity to present our perspectives and give you a glimpse of the conversations that we've had with bankers in the recent past who've been dealing with the pandemic, and how we feel that ERM, enterprise risk management, is an invaluable tool in mitigating the impact that arises out of this pandemic, which, as we are all aware, is here to stay. The impacts are going to be felt for quite a while. I'm sorry. So I have a couple of messages coming in from Cyril. Is there anything, Pratik? Can you hear me all right?
We can hear you. If you can start your slideshow option.
Okay. Yeah. Okay. You can see my screen, right?
Yes.
Okay. So we'll start off with this this ubiquitous enterprise risk management traffic lighted diagram. I'm sure the bulk of the audience today would have seen this diagram in some form or another, either as part of operational risk assessments or ERM assessments in general. But would like to draw your attention to the top left corner there, the low likelihood scenario with the high impact that oftentimes was glossed over in most risk management discussions. So much so that discussions around this event was considered fairly ridiculous and a waste of time to actually talk about this scenario, a scenario that was dealt with only hypothetically. But as events of the past have shown, reality doesn't really care for such opinions. The probability of occurrence of the pandemic, which sits in the top left corner of this particular diagram, is at 100% right now. The event has actually happened, and the impact from the event will continue to unfold over the medium to long term. So we'll try and spend time today to talk about how best ERM frameworks and ERM tools can help mitigate the impacts arising out of this pandemic, how it can provide invaluable frameworks, analysis, and tool sets to deal with pressures both internal and external, and how ERM forms an invaluable tool in the risk management's toolkit, so as to speak. Now that the black swan event has actually happened, there's no 100% probability events unfolding as we speak. We're seeing several effects emerge in the form of impacts from COVID, some shorter term in nature and some slightly more longer term in nature. In terms of impacts from COVID and the responses that we've seen globally, the shorter term effects tend to be in the form of loan moratoriums, in the form of some easing of regulatory compliance that has happened in some of the geographies. So there have been instances of key accounting regulations being deferred in terms of implementation timelines. Stress testing timelines and deadlines have been deferred in several geographies. So there's some regulatory changes being brought about because of COVID, and these are distinctly shorter term in nature. And then there are slightly more longer term effects that we are starting to see. One.
Put very close to your nose.
So
Hi. If the others can please go on.
Ashley, you can mute Mr. Magnus.
Right. And then there are others with longer term effects that are emerging, starting with periods of low interest rates that are being predicted across the globe, in fact, negative in some geographies. So that's something that banks are starting to grapple with to try and analyze how that is going to impact one, profitability, other, the kind of products that they would have to roll out into the market. So there are longer term impacts being felt on the interest rate risk side. And then there are newer risks emerging because banks have focused quite a bit on business continuity in general. Most banks, at least in the initial periods of the pandemic, have gone remote. There are a lot of staff even to date in several geographies that we are operating in where the bankers continue to work remote. And this has opened up another set of challenges in general with this push towards digitization and digitization of products as well. Risks such as cyber risks and data security risks have come to the fore. And there's a lot of work that has started to happen in these spaces as well. Another couple of risks and the focus on those risks like climate risk, for instance. Frankly, this was a risk that had come into focus pre-pandemic, but now with the effect of pandemic coming into play as well, and there's several, there's a lot of research coming out that suggests interlinkages between rising temperatures and climate change in general to more such pandemics in the future. So this is particularly come to the fore, especially with Basel coming out with several regulations and guidance with this particular regard.
Ashley, sorry, just if you can make your screen full.
Sorry. Okay. What we're also seeing is that there's increasing pressure on government to stir up the economy. There's a lot of government debt that's being sought out. The forecast from economists is that government debts are likely to keep increasing in the medium to longer term in the next 3 to 5 years. So it's key that banks have in place models that take into account sovereign risk, and that particular risk be also factored in as part of their risk management in general. And other such unintended benefits, unintended effects also arise in the form of there are entities that are strategically beginning to default on loans in the hopes that there are either interest waiver schemes or loan waivers that are in the offing. So all of these are impacts that we see emerge in the sort of short and the longer term as a result of the pandemic. As far as the risk manager is concerned, he's posed with several such questions that he's forced to address, starting with how does all of this play out in terms of how my balance sheet and P&L will look like? What is the impact on profitability going to be? What is impact on the NPL numbers going to be? And this is a key shareholder concern as well. From how do we cut costs in this environment and yet ensuring that operational resilience and the risk that we take as part of these cost cutting measures remain in line with the risk appetites that we have set. And now with this new normal being set in terms of working remote, in terms of dispersed teams, in terms of more digitization of the products, what are the operating SLAs going to look like? Especially important on the wholesale banking side, where turnaround times in terms of loan processing are crucial. From a regulatory standpoint, what is the impact on capital adequacy going to be? Are we going to be able to stay above the minimum capital adequacy thresholds that the regulator has set? And in some geographies, there is talk about the regulator providing some leeway in terms of lowering the thresholds for capital adequacy. So there's a lot of uncertainty on that regard in terms of what are the capital numbers going to look like in the next 3 to 5 years, as well as what are the benchmark or the minimum thresholds that banks will need to comply with going to look like. Lastly, we'd also mentioned, how does interest rate movements, how are they going to translate into one, impacts on profitability, but obviously there are linkages from profitability to capital adequacy as well. So the risk manager in post-pandemic, from the conversations that we've had with several banks, have actually been overworked more so than their business counterparts, because there is tremendous pressure on them to provide reports to senior management and to the board addressing one or more of these items in an environment that is fast evolving. So and this is really where enterprise risk management comes into picture. The tools that enterprise risk management function within the bank has managed to set up within the bank would actually help teams, risk management teams, and the CRO to be able to address these questions in the most efficient manner possible. In a traditional ERM framework, where risks are typically addressed in a very silo-based manner, you had particular teams, you had individual teams looking at risks in silos. You had teams looking at credit risk, you had teams looking at market risk, and other teams looking at individual risks in general. Now, if you have you have particular teams looking at each of these individual risk items, then it is a good start to enterprise risk management in general, but it is not truly integrated risk management, so as to speak. It becomes truly integrated only when the team is able to identify all of the cross linkages that exist between these modules that we spoke about. So what are the interlinkages between credit risk? What are the interlinkages between credit and market, credit and operational risk, and so on and so forth. So the starting point that the risk manager would have to try and address a few of these questions is to try and link the impacts arising from COVID to the particular risk type. And this is where risk taxonomy becomes important. For banks that have an established risk taxonomy in place, one of the first things that risk managers would do is try and link the impacts arising from COVID to the identified array of risks that they've identified as part of the risk taxonomy, and use this also as an opportunity to see if there are additional risks that need to be brought into consideration. So, we've done a very stylized mapping between the impact seen and the risk types. You have the usual suspects: the credit, the market, and the operational risk, and interest rate risk in the banking book, the typical pillar 1 or pillar 2A risks, so as to speak, that most banks now in most geographies are dealing with, from a regulatory standpoint as well. And then there are the other risks like liquidity risk, credit concentration risk, the climate change risk that we spoke about, as well as strategic risks that are slightly less quantitative in nature. But again, the level of sophistication really depends on the sophistication levels of the ERM frameworks that the bank has chosen. Now, if this is step 1 of identifying what are the various risks being covered, it still doesn't demonstrate the interlinkages between the risk types. And this becomes very quickly apparent if you start mapping these impacts to the key performance indicators, or the impact area, which is column number 3 in this particular slide. So once you start doing a mapping from the risk type to the impact area, you see that there are several impact areas. RWAs, the risk-weighted assets, for instance, there is impact on RWA because of COVID coming from credit risk, and there's impact on RWA coming from impact on via the operational risk side. The credit risk being driven, for instance, by changes in loan moratorium terms, by increase in default rates, etc., as well as a change in the asset quality profile of customers within the bank. On the operational risk side, as we had mentioned earlier, because of people working remote, because of dispersed teams and newer products being rolled out, obviously there's an increase in operational risk coming to the fore. So what this gives you is an indication of how a lot of these impacts are in fact interrelated. And while it is important that you have all of these boxes or the functions within your enterprise risk management framework, that there be boxes that look at credit risk, market risk, operational risk, it is also important to look at interlinkages between these risks. So, from a COVID perspective, the traditional way of looking at, for instance, impact of increase in loan moratoriums would have been to look at how does that change my RWAs, and how does that change my provisions number from a bank's perspective. And the typical route would have been to go look at how the risk weights changed as a result of changes in estimates of probability of default, of loss given default, of exposure at default. If the models are relatively sophisticated, you'd go one step ahead and be able to establish linkages to the macroeconomic conditions or the macroeconomic forecast that we've now started to receive. So this is a more traditional way of looking at risk, and it's an extremely silo-based approach, even though the model to create a linkage between macroeconomic conditions and the credit risk estimates tend to be relatively sophisticated. It's still a very traditional way of looking at risk. What is important is to be able to unearth the linkages and the interdependencies between the various risk types, and that is where true ERM comes into picture, to be able to create analytical frameworks, to be able to create governance, and to be able to drive strategy, taking into account a lot of these interlinkages. So, for instance, we're looking not just at credit risk linkages in this particular diagram, and we're not looking at just RWA and capital adequacy ratio as a metric. It is important to be able to identify metrics that look at your liquidity needs, your risk adjusted return, if that is falling below thresholds that are expected by your shareholders, then that needs to be communicated to the board of directors. Changes in profitability, changes in leverage ratio, all of these need to be considered while presenting, while a risk manager presents to senior management or to the board impacts stemming out of COVID. Now, for instance, most banks have already set forth in their journeys of trying to revamp their provisioning framework, because they found out that once COVID and the impact started coming in, they realized that the models that they had built earlier were no longer suitable for taking into effect the impact seen post the pandemic. So most banks have already set forth programs that revamp their capital adequacy models if they're on foundation IRB or advanced IRB approach. But on the provisioning side, they've definitely set forth programs that relook at estimates of probability of default, loss given default, and exposure at default. But a truly integrated risk management program would also look at cross linkages to, for instance, liquidity. They'd be able to establish relationships between they'd be able to model their changes in repayment schedule, for instance, of their customers, and be able to create linkages to the liquidity ratios. This, of course, requires not just analytical or statistical firepower, but it also requires a solid data model and a data mart to be able to pull off these interlinkages and be able to show these cascading effects. And that's where truly an integrated risk management comes into picture, because the data model that is at the heart of an enterprise risk management framework would drive these analytical frameworks, which in turn would drive the risk appetite framework and the risk strategy frameworks within the bank. And if you were to look at this particular framework that we've implemented for a few banks in the recent past, especially post COVID, we've also been able to take into account other risk types as well. We've been able to take into account interest rate risk related linkages. So there's market risk related linkages being also brought to the fore. As well as we've been able to model operational risk related events as well. So cyber risk is being taken into account, along with fraud related modeling is also being taken into account. So this analytical framework is key for the risk manager to be able to present to senior management and to the board the impacts that they see arising out of COVID. But then it doesn't really stop there. The demands that are being placed on a risk manager is not just tell me the impact, but they're also looking at, okay, the scenarios have changed. Can I get the answers now for the newer scenario? And also a lot of times the senior management and board also need direction as to, okay, we've analyzed what the impact is going to be. I see the results, but then what do we do from here on? And this is where the building blocks of an ERM again come into play here. A truly integrated ERM framework would have an integrated risk strategy and governance at the core of its integrated risk management framework. It would be able to take into account the risk strategy that has been articulated by the board. It would be able to distill that the strategy that has been given by the board into risk appetite statements, into risk limits and thresholds that can then be used to track if the bank performance or the risk being assumed are in line with those risk appetite statements or not. What is also key for an enterprise risk management framework to have is solid risk reporting to enable this decision making and to create these feedback loops to strategy and governance. So banks that have traditionally invested in programs related to, for instance, risk data reporting and risk data aggregation and reporting, BCBS 239, we found were better placed to deal with impacts arising out of COVID, because the entire data piece that was needed for this particular exercise and for the particular pandemic was already in place for them to be able to produce these results on a need to basis. They were able to produce these results um, on an ad hoc basis as and when newer requirements emerged, as and when the pandemic evolved. They were able to provide these information to senior management for decision making on a need to basis. What the ERM framework also takes into account is provide a solid basis for how capital management is going to happen. And by capital management here, we are referring to ability of the ERM framework to integrate their economic capital management process, their stress testing process, and RAROC. And in the recent past, there are banks that have taken to that have brought set about programs for recovery planning as well. So banks that have ensured close integration and alignment between a lot of these frameworks have been in much better place to be able to deal with the pandemic, because those frameworks are fairly mature and they knew what escalation procedures needed to be triggered in case the capital adequacy levels were to fall below particular thresholds that have been defined as part of the risk appetite. The third aspect of enterprise risk management is the ability or the sophistication when it comes to banks measuring risk across credit, market, operational, both pillar 1 and pillar 2 risk. Now, what has happened in the recent past is earlier there was the Basel framework that was urging banks to move towards higher levels of sophistication, and the definitions of probabilities of default, loss given default essentially came from the Basel framework. In the recent past, with the push from the accounting regulators, with the push from IFRS 9, banks have invested in developing modeling infrastructure that ensures that linkages between macroeconomic variables and the loss parameters within the bank are established. So there's a push towards sophistication when it comes to risk measurement that has already been afoot in several geographies that we work in. So that has been a welcome change that happened pre-pandemic also. And banks that, as I was mentioning earlier, that had invested in data quality and risk data aggregation related programs, they typically been able to set in place enterprise-wide risk data marts that ensured that the risk manager who was presenting the impacts that arise out of COVID were able to do this in a non-silo based manner, and that he was able to truly get an enterprise-wide view of risk and be able to present that to senior management. So these in a sense are the typical building blocks of ERM. And I think we have about a few minutes left, and I'll sort of wrap it up with the final slide here on benefits of ERM in general. And a lot of this are items that we covered as part of the talk pertaining to capital management. A solid ERM program would be able to take into account reductions in economic capital due to lower risk through risk management, and at the same time be able to maximize the shareholder value by keeping the company within risk appetite limits. Process automation has come to the fore now, especially with downward pressures on profitability, and there's a lot of focus now on ensuring that costs are contained. So again, process automation has come to the fore, along with superior data management and risk data aggregation and reporting programs that have also come to the fore as far as risk management is concerned. So I'll wrap it up with a few final comments, from an ERM perspective, banks that have ensured that they took an approach that was non-silo based, that was company-wide to risk management, have generally fared well when it comes to managing the impacts out of COVID. banks that have ensured that risk-related discussions are part of strategic planning, and banks that do not look at financial planning as something that's a responsibility of just the finance team, and where risk has a stake in the entire process. They've typically they've done really well in this post-pandemic scenario in managing the expectations and in managing the requirements that have been placed on the team to provide information to senior management and to the board for provide feedback and to be able to take decisions on that basis. So that sort of brings me to the end of my talk. I'll hand it over to Prateek.
Thank you so much, Ashley. It was quite insightful. Now, without taking much of the time, I'm going to transfer the presentation to Mrs. Oluwatoyin Olaiya. She is currently a CRO at FCMB Bank with 26 years of experience. She started her career as an auditor with KPMG and then moved to banking from Abacus Merchant Bank to Magnum Trust Bank and other banks in the country. She's an accounting graduate and also a fellow of Institute of Chartered Accountants of Nigeria. I would like to welcome her and thank her to join us for the presentation. Mrs. Olaiya, I'm just going to transfer. Ashley, I think you're still the host. You will have to transfer it to Mrs. Olaiya. You have to make her the host.
Okay.
Yes, Mrs. Olaiya, now you have you can share your screen.
Good morning, everyone. I hope I'm audible.
Yes, ma'am, you are.
Can you hear me? Okay. Thank you very much for this opportunity. I'd like to thank RIMAN as well for this opportunity and also for this topic at this time. I'll go straight into my presentation. So, enterprise risk management, a modular approach to ERM to optimize COVID-19 response. Okay, so Ashley has discussed enterprise risk management, and he has said quite a lot. But I'll just, the objective of my session is to focus on organizations, how we can improve operational resilience by taking advantage of enterprise risk management. Like he has mentioned, we need to move from, that silo mentality, from the traditional view of risk management, to the integrated view of risk management. So what is really the definition of risk? What I have observed is that a lot of people tend to equate risk with incidents, with losses. But the truth of the matter is that once an event has occurred or the loss has occurred, then it's no longer risk. So that risk has crystallized. So risk in itself is looking at the future. It's looking at the possibility. It's looking at what can happen. It hasn't yet happened. So they're more like threats, so it's looking at the future, and then you're saying, what can I do to minimize, the occurrence of this risk? And also looking at risk, it's more like a deviation from the expected. So for organizations, you have your KPIs, you have your corporate goals, you have your budgets, so you have specific indices that you're looking at, and that you have a target whether they're monthly targets, quarterly targets, annual targets. So the deviation, it could be negative, it could be positive. So the new definition of risk is rather than focus on downside risk, we're also looking at upside risk. So it also includes upside, volatility. So the definition of enterprise risk management, I love this definition. So we are aware, we know about the COSO definition, which is also important, the ISO definition. But really, enterprise risk management is the process, which companies utilize, to identify, measure, manage, and disclose all key risks to increase value to stakeholders. So I'll elaborate on that. Now, process. If you look at the COSO definition, it mentions that enterprise risk management is a process. But, most of the time we're looking at this department in that company or in the bank, and we say, oh, we have an enterprise risk management department, an enterprise risk management group. But that's not it. That's still going back to that silo mentality. It is a process. That means it cuts across the entire organization. And that is why it is called enterprise-wide risk management. And we have to establish those linkages. So that's the most important thing, to realize that it's actually a process. So it's not just that department that is responsible for risk. I'll be mentioning a lot about that as I go on in my presentation. So like I said, my objective is to focus on, this is not the practical aspect. As a practitioner, so how have we been implementing ERM in the banking industry in Nigeria? And now looking at how we can begin to implement it and derive the benefits that we want to derive from it. Now, I underline key risks, because for risk managers, it's not about identifying all. So you identify all the risks, but you need to prioritize. So in identifying the risks, so what are the key risks? I'll be mentioning that. And focus to therefore be on the major risks to the company's value. So now looking at this slide, if we cast our mind back, so in the 80s and in the 90s, risk management was pretty reactive. In fact, most organizations didn't really have a risk management department. They had internal audits, they had internal control, and then they had a head of finance who typically performed the role of the risk manager. So it was more reactive at that time, and looking at transactions, and then looking at the controls and the tick off and all that. So that was then in the 80s and 90s. But we all understand, we know what happened with Barings Bank and so many other issues that happened globally, and financial institutions that had issues, and then the Basel Committee, realized that, sometimes it's not just, this credit or financial risks that organizations are exposed to. So the concept of operational risk, market risk, started coming up, and saying that strategic risk and other risks that are non-financial, could also prove catastrophic to organizations. So the concept of integrated risk management, which is enterprise-wide risk management, started early 2000, 2002, 2003. So over a period to like 2012, the issue of enterprise risk management, which what Ashley has spoken to, which is actually having a portfolio view of risk across the entire enterprise, and not just saying, oh, what has happened in the credit department? No. So the integrated risk management framework is a bit more proactive, like I mentioned. It's not looking, because under the transactional, so once a fraud occurs or a loss happens, then you move into the remediation mode. Oh, what happened? Lessons learned. No. But under enterprise risk management, we're looking at an integrated view where we're saying even before you begin to anticipate, that is the major difference, between the risk management under the transactional approach and the credit. So you're anticipating what can happen. You're looking at the future. And I'm still going to speak to that. It's linked to the corporate goals and strategy of any organization. And you're saying, you know what? These are my goals as an organization for this year. I want to attain this balance sheet size in terms of profitability, in terms of customer acquisition, and they're pretty specific. You have your SMART goals. But in terms of the risks, for you to get from here to there are certain bottlenecks, which are the risks. Now, those risks are the threats that could derail you from achieving. your year-end goals. You know, so what integrated and enterprise risk management does is that it enables you, it gives you the opportunity to begin to anticipate so that you can address. So we're coming to risk mitigation and minimize should that risk occur. So it's a bit more proactive, and you're utilizing tools which I'll speak to. Under ERM, there are certain tools that we use, and I'm going to come to that, you know, because I believe that the essence of this webinar is to have takeaways, practical, especially for us in Nigeria. It's like we know the theory, but how do we actualize, you know, and derive benefits from ERM? There are certain tools like the RCS, the risk and control self-assessment, loss events data collection, key risk indicators, you know, and I'll be mentioning that as well. So, but now, so yes, ERM 2002, 2012, you know, and even in Nigeria, regulators, you know, after the consolidation in 2006, it became a regulatory compliance issue. But starting like 2013 to date, there is now a shift that from ERM to strategic risk management, which is even looking at risk management as a strategic enabler, you know. So under the ERM integrated, it's more like maybe still looking at the risk manager as a policeman, saying no, NO. But under strategic risk management, you know, what ERM is doing now is like, instead of saying NO, no stability, and now am I able to advise, you know, executives at the board and senior management what we need to do, and I'll be speaking to that. So this pyramid is looking at enterprise risk management, just building up on what Ashley has mentioned. And now saying, now we're talking practical in a bank or insurance company or in an organization. How do I implement everything that Ashley has mentioned? What do I do? How do I go about? Because I know that is the major issue. A lot of organizations go into purchasing software and systems. It doesn't start that way. The foundation is critical. And if you look at this pyramid, the culture, that's another topic on its own. But because of time, I can't delve into that. But it's important that you have the appropriate culture in place to support the enterprise risk management framework. A lot of us as banks, we have our enterprise risk management framework, we have our policies, we have the subsidiary frameworks, you know, addressing credit risk, market risk, operational risk, strategic risk, you know, even our ICAP documentation, we look at material risk exposures, you know, so we have all of that. But the thing is, without the appropriate culture to support that, the ERM framework and your journey may still be at the infancy stage. So looking at this diagram, you can see that it's the tone of any ERM framework. For it to work, the number one requirement is tone at the top. And the CRO or whoever is heading risk management has responsibility to drive that. And that is why even Basel came out and said there must be that, linking the role of the CRO with enforcing risk appetite. So it starts with the risk strategy. A lot of times we have organizations, you know, where they implement the corporate strategy and the risk management department is playing catch up. No, but that has changed. Now, with what is happening, ERM moving into strategic mode, that has changed. So you have risk strategy right there, you know, at that peer level with the corporate strategy. So where you have the risk management strategy in alignment with the corporate strategy, where the organization has said this is where we're going to be in 3 years' time, in 5 years' time, these are short-term goals, these are long-term goals. And risk management is saying, you know what, you want, these are your end goals. But for you to achieve these KPIs, for you to achieve these targets, these are the threats. That's where we come in as risk managers. And we're saying, you know what, for you to do this, these are the things that could derail you, these are the things that could threaten you, and then these are the threats and risks you have identified that will prevent or hinder you from achieving your strategic goals. Then that is risk management strategy. That means, what do we now do? Which fits what I should say. What do I now do? So if my strategy is, I want to increase, you know, customer base, you know, maybe I'm in consumer lending, or, you know, I'm in retail. I want to increase customer base to 1 million. So what are the things that could prevent this, my branch, from achieving that? It could be that, look, I need resources, communication strategy, whether it's direct marketing. So those are the threats. So that means we're telling management, if you don't address this threat, this particular SBU will not be able to meet its strategy. And then you have the risk appetite. So that is the umbrella, because every organization without the risk appetite, the ERM framework cannot work. And that is the honest truth. The risk appetite, that is where you as an organization, driven by the board, there is consensus agreement that these are the levels of risk we are willing to take. If there must be that agreement, otherwise the risk management department will find it difficult. But once that appetite is speaking to the level of risk you're willing to accept, that you're willing to take, and it's across the entire enterprise, and then you're communicating it. That's your it's very, everybody knows. So the RM that is going around, saying that he wants to bring in deposits, he already has an understanding of the kind of deposit profile that has been defined in the appetite statement. And he knows, am I a low risk bank? Am I high risk? Am I willing to take? So all that is known. So communication is very important. And we're talking about governance. Governance is key. And the issue of independence of the risk management function. For ERM to work, that function must be independent so that it eliminates or minimizes conflict. So these are some of the things, I said I would mention. And then you look at risk and capital, all the models that Ashley has mentioned, people, management, information. I'm still going to talk about that, technology and infrastructure. Now look at what has happened with COVID. And I'll mention that, so that is an external event. And I'm going to I'll move on to my next slide. So how, like you mentioned, this was an event that appeared and no model would have predicted it, just like the 9/11 incident. And I'm going to come to that. How would ERM have prepared organizations? When we're saying enterprise risk management, we're not talking about eliminating risk. In any risk management process, risks would occur. But what we're talking about is, how do we now put in place a strategy to minimize the impact, and are we prepared? That's what ERM is about. And I'll quickly speak to the process. If you look at this diagram, so the risk management process starts with risk identification. Because of my time, I quickly move on to this slide where I will be explaining, looking at that identification. The number one step in the ERM process is to identify the risks. And like I mentioned, because ERM is the process, and here we'll be speaking to the 3 lines of defense. So it cuts across the entire organization, and this is the how to implement ERM. So it's not just to have the framework and the policies. So from the RM, from the guy in operations, from the teller, the 3 lines. So you have the first line of defense. So the people that are generating the risks, the RM that is bringing in the deposit, the teller that is paying or receiving the cash, the person, that is in admin buying the generator, or everybody is generating risks, whether they're operational risks or market risks, or, we now know all the different kinds of risks. So the ERM process starts with the risk identification process. And there are certain tools that we use. The risk and control self-assessment is an important tool where the people in the first line are the people that are interfacing directly. The RMs, the guys in operations, the CSO officers, all those people that are interfacing directly, with clients, out there, that are the ones generating, I call them risk generators. They are the ones generating the risks. They sit in the first line. So what we do, because risk management sits in second line, working with those that are actually generating and booking the risks, is to ensure that every office, every role has a risk register. Where they are, like I mentioned, what I said about risk? Risk is not that event that has occurred. So the RCS enables you to identify what are the possible threats that can happen on my job as a teller. So all these risks are identified. And then we now source all the risks. So what is the likely source? That is what we call cause and effect. So if this potential risk, what can cause it? If you don't do cause and effect, then it's not. You have to do what can cause it. What will be the effect if the risk should crystallize? And notice my word, it's potential. It hasn't happened, we are anticipating. Then we're not coming to measuring the risks. We are all familiar with that. We talk about our heat maps. We're talking about the severity. So now I'm not talking about incidents now. This is still the ERM process. So in that particular role, you have identified the possibilities, the possible risks that can occur on this job, on this role. It has been listed out. You have done your cause and effect, the potential causes of these risks. You've done the risk driver analysis. Then we now come to an important aspect of it, because what is not measured cannot be managed. Some of the principles of risk management. It's the ERM process that brings it out. You know, so for a lot of us, we already have that in place right now. And this is where you are doing your risk. This is where you are doing the risks. You are doing the severity, the likelihood, and the financial impact. And I'll quickly move on to the risk map, which we are all aware of. You know, so if you're following me, you're identifying the risk, you're sourcing the risk, you're measuring the risk. In measuring the risks, you are mapping. Now, this risk map is very important, because you would now have identified the risks and you are now looking at, so this particular risk, you are doing what we call the likelihood of occurrence. That is the risk assessment. The measurement, this number 3, you know, is the assessment of risk, where you are trying to assess the level of that risk. Is it a high risk? Is it low? Is it medium? And when you're doing this, looking at that risk and saying, what is the likelihood? And for a lot of us, you have the likelihood scale, your consequence scale, like Ashley has mentioned. And at the end of the day, you have different types of risks, and they will be in these quadrants. You have the high risk ones, and the number 4 step there is once you have identified and you have mapped that the risk mapping process is fair. And this speaks to the heat map. So you have 4 quadrants. So the top right is the red zone, where you have risks that the likelihood of occurrence is high, and the severity should it occur is high. For those ones, we're not talking about the risk management strategy, like the COVID that has happened. The COVID that has happened is in the reduced manage, is in that upper left quadrant. That means the frequency of occurrence of such pandemics, you know, historically is low, but the severity is just like the September 11. So these are low frequency, high impact. They are in the yellow zone, but they could prove catastrophic. So, like the COVID-19, that in itself is that risk. What do? It's a pandemic. Your risk management strategy should be, you know what? I need to manage this, and that speaks to all of the things that we have put in place to manage COVID-19. We have triggered our business continuity plans across the enterprise, you know, revised work arrangements, social distancing, working from home initiatives. We have revised our operational procedures in the way we attend to customers. We have encourages of e-channels, investment in digital platforms. All of these have, but these are some of the things we have put in place to manage, you know, and they're looking at the balance sheet. A lot of businesses close down. So cash flows have reduced. Customers are not paying us. So in terms of credits, what are you doing? You're restructuring. So you're reducing, you're managing. So depending on where you plot, like, okay, I can accept this. So that's talking to the risk strategy, which is the core of ERM. This step 4, you have to get the risk mapping right, because this is now speaking to how do we respond to events like COVID-19, which I'm going to speak to. If you don't do this, because if you had been doing this, you would have been anticipating that should this happen, then I will now come to scenario analysis. So now, on a regular basis, ERM, like Ashley has mentioned, and like I also mentioned, if you do not report the risks, what is not measured cannot be managed. So, but you can't skip to reporting without measurement. The measurement, because by the time you do your likelihood and impact assessment, you will now prioritize, because it now tells you, that's what you call risk profiling. So, like I said, enterprise risk management is having a portfolio view. So across the enterprise, you have looked at tailoring, you have looked at operations, not just credit risk. And at the end of the day, you have that portfolio view of all risks across the enterprise. It's what we call the risk universe. Once you have all those risks, you now rank them because you've done your likelihood and impact assessment. You have the risk scores, and you now sort in terms from highest to lowest. And there's this rule of thumb. What are the top 10? The significant risk, you prioritize. So once you now come to management with that hit and say, these are the risks that should they crystallize the impact on the bottom line. So as you're now doing that, you are now presenting to management what we call risk mitigation. That how do we now, or risk treatment, before this risk crystallize, hey, and there is another to call key risk indicator. What it does is that it tells you, like your dashboard, hey, you're at amber zone. Address this risk now before it crystallizes. And as you're doing that, your risk management strategy to board and senior management now becomes the specific recommendations that you're making for those risks that you have prioritized. And you're telling management, we need to respond now. These are the things we can do to minimize these risks. So when you're talking about the reports, risk maps, you have P&L attribution reports. And I was talking about risk maps. You know, on the P&L attribution, you are looking at how do we make or lose money and from what factors. You are dimensioning the balance sheet. What are the earnings at risk? It's not just credit. What are the earnings at risk? In our portfolio of non-earning assets, you know, what are we exposed? You know, how can we rejuggle the balance sheet? How do we, you know, change the strategy? Risk versus limits. You are coming up with reports that showing whether, because limit management is also is a risk management strategy where you limit, you know, your exposure to risk. So sectoral limits, concentration risks, you have limits, and so all of that, exceptions and near misses. Near misses are very important. You know, so it occurred, but you didn't lose, but it's a flag because Basel says your operational risk is the risk of loss, you know, arising from failed inadequate people process systems. So maybe there was a control there, and that's what the RCSE does. So that control, yes, it was there, but was it adequate? Was it effective? So you begin to do lessons learned, and then you begin to recommend, you know what, this is a near miss, but we have to do this so that it won't be your call. Then scenario analysis, which is an area of the ERM process that I have observed, where we do a lot of the risk and control assessment. We do loss events, you know, data, you know, gathering, we have the database, we do our key risk indicator analysis. But honestly, for risks that are external in nature, like COVID-19, like the September 11 event, it's the scenario analysis, which is a very, very, very important tool, you know, in the ERM process. What it does, scenario analysis is not about risk management coming and, you know, people already, you know, look at us as doom and gloom, but what scenario analysis is, you're painting various scenarios. You're not painting those scenarios, you know, to scare anybody or to predict that this will happen. You just come up to your risk manager and say, what if this building collapses? You're not set. But what you're trying to do is, should it happen, to get us to be prepared? That's what it does. And then to get everyone thinking. So that was scenario analysis does. You know, so to sum up, you know, complementing what Ashley has said, you know, the linkages he mentioned, because credit risk, market risk, operational risk, cyber risk, there is overlap. Like the global financial crisis, credit risk trigger liquidity, systemic liquidity, and all of that. So at the end of the day, we must be able to quantify enterprise risk exposure, which is another gap that we observed. But from what Ashley has said, you need the data sets. You need the systems that will enable the risk manager of the future, of this century, to be able to come to executive management and the board and to say, yes, I've done my risk map, you know, because people are used to us saying this is high risk, and they're wondering, okay, you've told us, you know, risk manager, CRO, this is high risk, medium. Okay, so boards and senior management, they are waiting for us to quantify and say, sometimes we're able to do for credit risk, but for strategic and operational risks, these are the non-financial risks, are a bit more difficult to quantify. But with systems that are coming up nowadays, we must be able to get to the stage where we are able to give that view of enterprise risk exposure. On these key questions, you know, I won't delve more into this, but these are questions that any ERM framework is aiming to address. You know, at the end of the day, as a risk manager, we should be asking ourselves, is our monitoring effective? Are we improving on a timely basis? Are our capabilities executing our strategies, our risk controls and oversight effective? So how do we begin to measure? So I'm rounding up now, because of our time. I just said, I'll try and bring up some practical things that we can do. How do we measure, this is my last slide, effectiveness of the ERM framework? A lot of us on this call, we're practitioners, either in the insurance industry or in the banking industry, or any organization. In every organization, there is need to manage risks. But how do you measure the effectiveness of any ERM framework? It is that number one, the integration. Have you been able to integrate? Have you been able to have that visibility, over, all the risks across your organization? Are the risks still being measured or monitored in silos? Improved risk identification. Do you make use of the risk mapping process? And have you moved on to risk measurement and risk profiling? Do you have an idea of your top 10 risks? And have you gotten to the stage where you're able to profile recommendations, which becomes your risk management strategy? Have you been able to implement an effective analytical early warning techniques, which is speaking to the data systems at this time? These things are required. Improvement in specific measures. So we have to shift from guessing, which was the first layer, the transactional. So that, and like he actually mentioned, IFRS 9, the Basel 2, so as you're generating credits, you can estimate probability of default. These are estimates, but it's giving you some visibility as to the probability that this obligor will default. Or even when it comes to market risk, that's another area where we need to build capacity. A lot of market risk frameworks are probably just doing liquidity risk management. Our gap analysis, we're looking at exposures based on maturity mismatches. But have we gone into duration gap? There's so many other things that we're supposed to. That's what ERM is to have a view, and then you quantify it so that we'll be able to recommend solutions that will be actionable. Another important thing is the timeliness of the reporting. Any information that is not timely, then executives cannot take decisions on time. So that's why we need to automate. So right now we're talking about machine learning, right now, robotic process automation, so many things, artificial intelligence, and a lot of systems have been deployed globally to empower risk management functions in terms of timeliness of identifying, measuring, and reporting risks, so that, because the end objective of ERM, to add value to any organization, is not just to end with the reporting. It is to enable strategic decisions to be made by board and senior management. And at the end of the day, in terms of, so that we do trend analysis, and what that does is, are you seeing reduced number? Because at the end of the day, that's the true test. Number of risk incidents and losses. So you're monitoring, so you must have quantitative metrics as well. Asset quality, performance ratios, you're monitoring, specifically to your company, and looking at industry average as well. How are we faring? So there's what we call the trend analysis and risk. Key risk indicator helps that as well. So you're monitoring, and then the indicator is telling you, so if it's going up, so there's the concept of the direction of risk. It also helps if the incidents in terms of frequency, that there is either the control there is not efficient, it's telling you that the direction is, and I'll end on this note, risk management as a second line of defense. A lot of organizations tend to think that risk management is third line. Internal audit sits in the third line. That means once that loss crystallizes, internal audit comes to investigate, and that's why I talk about lessons learned, what happened, and that's remedial. They're now clearing up. That is not the role of risk management. Risk management must sit in the middle line and say, before that risk becomes a loss, that internal audit is not investigating. The true test of any risk management function is the ability to minimize what is going to third line. That means you've been able to proactively anticipate, identify, report, escalate, and then make recommendations so that when a risk crystallizes, the CEO and the board must be able to make a statement that risk management mentioned this. They make recommendations, but maybe we didn't, because that's the role of risk. You put it on the table. It may not be approved, but at the end of the day, the true test of the effectiveness of any ERM framework is that the approval authorities are able to say that they were aware of this possible threat. So it's not that when it crystallized, like even risk didn't know. So that is why it is important, this webinar is important, everything we need to do as risk managers to ensure that visibility. Let's talk about cyber risk. For a lot of organizations that did not anticipate years ago, who would have known that now, working in environment arrangements, working from home, organizations that were not even ready, that had not addressed data security, application security, endpoint security, and then COVID-19, that's the beauty of ERM. If those scenarios had been anticipated and the risk manager had gone to the board and said, you know what, this is not based on what we're seeing in the landscape, there is a possibility that in the future, cyber risk could move from let's make sure we plug all the gaps. Let us make sure that we have a cyber security. And then by the time things are happening as an organization, you are ready. Cyber risk now has moved. It's one of the top 3 risks globally. And then COVID-19 has moved it to like number 1. Because a lot of risks are now happening. My time is fast spent. But I just said I'll end on that note. That as risk manager in the second line, please let us make sure that we are fulfilling that second line mandate. So I'd like to thank you and I've overshot my time. And
thank you
I'll
so
now
much.
hand over to.
Thank you so much, Mrs. Olaiya. I think it was a very, very, sort of in-depth presentation on a practitioner's view. I'm pretty sure that, a lot of people who joined us today were able to take good note of the same. So without taking much time, I'm going to, request Ashley to, sort of take few of the questions. He can answer himself and also share thoughts with Mrs. Olaiya. We have few questions that have been posted by attendees also, and there are a few questions that we also wanted to, from Aptivaa ask Ms. Olaiya as well. So over to you, Ashley.
Thanks, Pratik. So there's a question that's come in from a participant, and I'll let Ms. Olaiya take this. The question essentially is that the participant agrees that risk should not be looked at or managed in silos. The question really is, how does the bank go about setting up a structured ERM program? So that's question 1. The second part of the question is, should there be a separate ERM desk or a division, and what kind of competence is needed? And along the same lines, what would the role of CRO be in setting up an ERM desk of this nature?
Okay, so I got the first question. How do you set up an ERM program? What's the second one?
The second one was whether it should be set up as a separate desk or a division, and what skills are needed. And the third was, it's all from the same participant, was what would the role of CRO be in this regard?
Okay, so to set up an ERM program, so it's important, that like I mentioned, the tone at the top, you must come up with the ERM framework and make sure that you get that approval. You need the support of the board because board has overall oversight for enterprise risk management. So you can't just jump into the program. So the policy, the framework, that's the foundation, because there you are articulating all the building blocks that we have mentioned. Everything must have been articulated there. So once you have your approval of the framework, then you must now have a plan, which is the ERM program. And depending on where your organization, so that you have what you call the risk maturity capability model, where you do an assessment of your specific organization. That's the first. You must do a gap assessment. Where are you? Are you at the basic level? Level 1? Are you level 2? So by the time you identify your gaps, then you come up with a roadmap to implementing your enterprise risk management program. So that's the way to go about it. So, and in that program, you will now have specific deliverables. It starts with the framework. You identify the various risk domains, which must also have their own programs as well, and their policies. Then you're looking at governance, is very important. Manning levels and all of that. So that is how you set up your ERM program. And there are various steps that you take, to implementing enterprise risk management. So, and I mentioned that in the course of my presentation. Now, in setting up a separate desk or division, so I'll answer it this way. So in emerging markets, like I mentioned, the ERM division is still in the second line. And you have the ERM department sitting, reporting to the CRO in the risk management division. So yes, it is important that you have that desk, but the role of, like I said, that role is more to facilitate working with those in the first line. So working with all the SBUs across the enterprise, whether they're in branches, whether they're in operations, and assisting them in that, because not everybody understands risk management, but assisting them in identifying the risk, using the risk and control self-assessment, questionnaire, all those tools I mentioned, key risk indicator setting. So the ERM department is necessary to ensure that all of that is done. So I would always advise that you set that up. But globally, I know that in some countries, like in North America, that's why I talked about maturity. So for us here, we're still maybe at level 3 or so. But, in the United States, where they had even implemented ERM years before, Professor Soludo and what happened, and it became a regulatory requirement. In North America, in Europe, they had implemented ERM before. So for them, you find that most of their ERM roles, especially operational risk management, has moved into first line. But they still have the corporate, department in second line monitoring those that are now sitting, because they've discovered that if I have my ORM specialist sitting with the business guys, they are better able to advise. But for us now, we have what we call risk champions, which we take from the business units anyway. But yes, you will still need to set up a desk to ensure that things, are being done appropriately. So the role of the CRO, sorry, I didn't get that. You said role of CRO.
I believe the question really is, how does this role or competence differ from the role the CRO should be playing in order to set up an ERM desk or a division? So would that be complementary? Would the head of ERM be the CRO, in your opinion, is really what the question is.
Oh, okay. No, so it depends on different organizations. So right. It's not just banks. So there are some organizations where whoever is heading the enterprise risk management is also the chief risk officer. So it depends on the hierarchy of authority in the organization. But typically, some organizations have ERM, some don't even have ERM. The CRO is also the head of ERM. In some organizations, they have ERM as a department, maybe just to focus on it. But the most important thing is that our risks being identified, being monitored, being measured, being reported. How it sits is the governance. As long as that role is independent and is reporting directly, to risk committees, that's fine. Thank you.
It's interesting you mentioned risk champions from business, because what we've seen is in a lot of the ERM implementations that we've done, for an effective ERM implementation, that buy-in from business is crucial. And a lot of times we've engaged with risk management teams to set up analytical frameworks, something like a risk-adjusted return on RAROC or a funds transfer pricing framework. But because of issues with change management or a preference for status quo, a lot of times risk faces this challenge of being unable to sort of embed these processes in business as usual mode, which is where the buy-in from business is crucial. So risk champions, for instance, I'm sure that would certainly have helped in an ERM journey. But what has your personal experience been in trying to get business to buy into a lot of these initiatives that typically risk management initiates?
Yes. So thanks for that question, Ashley. So in my experience, it has worked. So because you're trying to get those that are generating the risk to take ownership, because they sit in the first line. So having risk champions, from those businesses. So whether it's a marketing department or customer service department or operations department, there's this concept of subject matter experts. So they are the ones really that are performing those roles, either as a teller. They are in a better position to identify the possible risks that could crystallize as they are doing or performing their role as a teller. So, but we are sitting down with them to guide them because they may not understand some of the risk terminologies that we, and they are better equipped. So what we typically do is you try and build capacity in terms of the skill set. So by workshops, sensitization seminars, you gather them together, you keep, explaining to them ERM, Basel. So they have an understanding. You explain to them how to identify risks, how to actually test controls, how to identify whether a control is weak, either it's strong, is it working, because they are better positioned to tell you, how to update risk registers. And then the reason why the risk champion methodology works is that the concept of risk register, how this person sitting in second line cannot update, but that guy or that teller, something happens right there and then in his branch, and he's able to update. So that risk register becomes dynamic. He's able to update, and then because they have dotted reporting, he's able now, as he's updating, we are now having oversight. We know this thing just happened in this branch, and then you have that oversight, and and then at the central level, at the risk committee meetings, we're able to advise management, hey, this thing happened in branch B. This thing, how did we know? It is the risk champions that gives us visibility across there's no way the risk manager, in the central office would know what is happening in the branch, in a particular state. But with the liaison officers, they are there, the risk champions, they know their role that, and they now understand that we're not auditors. We're not there to say, okay, report this, self-assess. They understand that what they are doing so that we can improve. So that's the way it has worked. Sensitization workshops, attending the meetings, having risk meetings as well. Where the risk champion sits, even with the divisional head and the group head, and you're letting them know what makes you, not a slave, and they're understanding that what you're just doing is to find out the issues that they're grappling with so that we can prefer solutions.
Sure. Especially now in this post-pandemic era, so as to speak, there's been a lot of changes in the work culture in general. Working from home, working remote, etc. So there's also this. There was a survey that said that because there was increasing focus on operational resilience, the focus on risk management has reduced, so as to speak. Now, I completely have a divergent view. This is probably the time where risk management should be at its most vigilant. But again, from somebody who sits in on board committees, do you think the post-pandemic has seen the importance of risk management in general go up, or would you say that it's taken a back seat?
No, it hasn't taken a back seat. In fact, based on my experience, so a lot of analysts, a lot of investors, a lot of third parties, they actually want to speak to the CRO really. So risk management hasn't taken a back seat, and that's where ERM comes into play. So you're talking about business continuity planning. So had you anticipated? Did you have response? Plans in place. Did you conduct your impact analysis? Were you able to identify critical resources should, across whether it's earthquakes, not necessarily COVID, so they're actually interested in the governance. And, in the structure. So risk management has not taken a backseat. Now, what you're saying, yes, what I've noticed, the issue of resilience, but where it's coming from, like what typically happens, it's rather than, a lot of discussion around operational risk has occurred. So globally, rather than say operational risk, we're talking resilience, which is the same thing. Okay, so we've been managing operational risks, people, process, systems. The resilience part of it is that, are we so it's still our last scenario, it's still operational risk management. So should this risk crystallize, how resilient? So it's speaking to cybersecurity resilience as well. How resilient? So it's still ERM. So that's the way I don't see, so there's a focus on resilience, operational resilience. But it's talking about, are you resilient? Are you able to withstand? And you now link it to capital. Are you able to have the capacity to withstand? Everything is linked, like you said. ERM links everything. And one thing I like about Basel is that, irrespective of what ERM is doing, by virtue of Basel and the capital adequacy requirements, it kind of limits, you cannot generate risks beyond your level of capital as per that accord. So even if you're doing it transaction-wise, when you get to that, so it's not like a portfolio risk management, it constrains. So in a way, the Basel Accord, yes, you can still be taking your risks, but it comes to a level where your capital and the buffer there will ensure that you're within, what your capital can tolerate. So that's what resilience, whether at the capital level, cyber, operational, it's still talking about risk management. So the role of the CRO is still very important because boards and senior management, they want to know. They want to know. They want to know what's happening. Visibility, they want to know. So that they can take decisions. Time.
Sure.
Actually, we have time for just one more question. Then we
All right.
have to
I'll take the last question, and I'll sort of try and answer this one. The question pertains to, how does one create linkages between macroeconomic indicators and credit performance if are only probabilities of default and loss given default involved? And how do we ensure mathematical results speak well of realities? So the short answer is that no, there is no limitation on the extent to which these empirical models can be built. So most banks that we've been working with in the recent past have built models that link probabilities of default and loss given default and exposure at default to macroeconomic indicators, primarily because of IFRS 9 requirements. So the last couple of years, we've seen banks investing a fair amount of analytical, there's been a fair amount of spend in the analytical space, both in terms of time and resources to ensure that these models are up and running for accounting requirements. But also, banks that have a vision for a truly integrated risk management or an ERM framework, they've gone beyond this and have set of frameworks that link macroeconomic indicators to, for instance, balance sheet growth, to new volumes of loans coming in. They've been able to, create behavioral models as far as their deficits are concerned. So macroeconomic indicators and the modeling that occurs around macroeconomic indicators is not limited to credit. It can be extended to interest rate risk, to liquidity. Also, we've seen macroeconomic indicators, for instance, being taken into account for on the operational risk side as well, where all of these indicators are being taken into account. So yeah, there's no limitation as such when it comes to the extent to which these indicators can be used. As far as how do we ensure that realities are being taken into account? Now, obviously, all of these models, a lot of times are being built in a low data environment, so as to speak. So it is always important that the risk management looks at these models from a pragmatic view. He may be able to glean certain insights out of this model, but eventually, if the model that's being developed or the statistical model that's been thrown out of your toolbox does not make intuitive sense, then he's got to relook at the assumptions and or the modeling methodologies being used. With that, I think we've come to the close of Q&A session. We will be sharing the decks that were used as part of today's presentation. Thank you so much, and over to you, Prateek.
Thank you so much, Ashley. Thank you so much, Mrs. Olaiya. We had a very good webinar session today. Unfortunately, due to the lack of time, we were not able to answer all the questions. But what we have done is we have taken note of all those questions, and we will be responding to all those questions. We will be taking comments from both Ashley and Mrs. Olaiya, and would be sharing it with all the participants along with the decks. So that the questions that were not answered or were asked, questions that were raised by other people will also be shared by everyone. Thank you so much, everyone, once again. And with that, we will end the webinar. Thank you so much.